Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just an hour to go now to the closing bell, and stocks are higher on that back of that cooler than expected inflation print. Our very own Inez Ferre standing by with all the headlines. Inez.
Hey, Josh. Yeah, we are seeing across the board stocks that are higher, although we are off the highs of the session. We can see a little bit of a sell-off that we've seen here over the last half hour or so. Taking a look at the NASDAQ composite up above the flat line, the S&P 500 up almost 0.2%, but again, off the highs of the session. Looking under the hood, where we're looking at real estate stocks, we're looking at healthcare stocks. Those are the ones that have been leading the gains today, along with utilities, as we continue to see that rotation that has been sort of away from tech and into more defensive and cyclical sectors. Over on the Dow, just want to show you Visa down more than 3%. You've got NVIDIA that's lower as well. Apple also extending losses from yesterday. But take a look at this. Walmart hitting an all-time high, another all-time high for today after it closed at an all-time high yesterday. Also looking at the NASDAQ 100, a mixed picture that you're seeing there. The semiconductor stocks some of them doing okay. And then the software stocks also a little bit in the green after we've seen a big sell-off in software stocks over the last few weeks. Looking at the crypto space, Bitcoin up more than 4%, hovering just below 69,000 per token. This is over optimism about the Clarity Act and whether or not it'll pass this year. And then just looking at commodities, we have seen oil that is a mixed picture here for crude oil, but look at gold. Gold above 5,000 again after that sharp sell-off that we saw yesterday. Silver also up again today after yesterday, that sharp sell-off, along with that broader market sell-off that we saw. Josh?
All right, thank you, Inez. Appreciate it. Well, January's consumer price index showed slower than expected inflation and the lowest since May. Yahoo Finance Fed correspondent Jennifer Schonberger sat down with Chicago Fed President Austan Goolsbee to talk about how inflation, tariffs, and the labor market all play into the Fed's rate path in 2026.
There was an encouraging bit in the CPI number today, but there were also still some concerns. I would say it's encouraging that on the food and the energy side, you saw pretty significant improvement. The goods inflation, which is where mostly we've seen the impact of tariffs, the new month that came in, the number was okay. And the more concerning part is we're still seeing pretty high services inflation, which is a thing which tends to be persistent. So we're going to still get a producer price index inflation, and we're still going to get some more information. Let's hope that we've seen peak impact of tariffs on inflation and that part proves to be transitory.
Want to ask you about the job market, because this week we got a stronger than expected jobs report. That payroll number very strong, the unemployment rate dropping to 4.3%. Although a lot of the job growth still coming from just one or two sectors, healthcare, social assistance, and so on and so forth. I know that 1 month does not make a trend, but what was your sense about whether this was a confirmation that the job market has stabilized here, given the 3 rate cuts that you did last year? And is this a sign of perhaps better things to come from the labor market?
Well, as you know, my view of the labor market has been that it has been steady. I think it's been cooling very modestly. But if you look at the unemployment rate, if you look at a lot of the rate-based measures, like the layoff rate is low, while simultaneously the hiring rate is low. That's an unusual combination that doesn't really scream out beginning of recession to me. I thought this month number, like you suggested, 1 month is not a trend. The overall jobs created for last year was low, but I think a lot of that is because immigration crackdowns and low labor supply. This strong month, hopefully, is a sign of stability in the labor market, that things like the unemployment rate, which have been steady for almost a year, that characterizes how the labor market is. And I'm optimistic that if that's true, and if we could get some more improvement on the inflation side, as I say, I think rates can still keep going down a fair bit more, but we just need to see the progress on inflation, and we need to see that the job market remains steady like it has been for a couple of months here.
I do want to get into your outlook for the rate path, but before that, what is your outlook for the economy for this year? The Fed overall seems to have a more sanguine outlook. As mentioned, you've done 3 rate cuts at the tail end of last year. We're expecting some fiscal tailwinds this year, especially with the larger tax refunds expected. What's your sense, and how does that bode for the job market if we do see better growth? Could we see higher employment across more sectors in this economy?
I think we had pretty strong growth for 2025. So if we matched that and maintained this at least as fast as trend growth, and maybe even faster than that, that would be great. I think the thing in some people's mind, AI investment is dominating that growth. My read of the data is a little different. I think the strongest thing in the economy is the U.S. consumer, and you saw consumer spending really sustaining the economy throughout 2025. And my outlook so far, if the job market remains stable and if we could get the inflation rate down, I don't see any reason why the consumer could not continue to sort of power a sustainable recovery and that we could have a strong economy. That's a separate question from the old vibes question. Why do people say that why is consumer confidence down, but they still continue spending at the rates they were spending before consumer confidence fell? That's a tougher nut to crack. But I think the Fed, by law, is required to look at the actual numbers, inflation and employment. And I'm hopeful that for 26, inflation and employment can stay down that middle of the road.
Well, it sounds like you still have some concerns on inflation, as we talked about at the top of this interview. And last year, you said you were wary about front loading too many rate cuts for kind of making the conclusion that inflation was going to be transitory. And in December, you dissented against cutting rates because you wanted to have more time to wait to see the data, the job market, the economy. Now that you do have more data, do you think that 3 rate cuts last year was the right thing to do? Is the Fed funds rate restricting the economy at this point?
Well, I don't know. On the last part, I don't know how restricted we are. Inflation's been above the target for more than 4.5 years now. And we need to see improvement in inflation, not just count on that it will improve on its own before we start making the rate cuts, in my view. Now, I still expect that we will see the progress. I still want and believe that the tariff part will impact the price level, but that we can see progress and that inflation come down. I'm still wary, though. As I say, if you look at even the inflation numbers that we've just gotten, services inflation is not tamed in the CPI. We'll have to see what the services look like when we get the PPI inflation next week, but that is a category that's not supposed to be being driven by tariffs. The tariffable content of services is very low. So if you see inflation well above the target in services, that's a danger sign. And I just want to get some more information before we start front loading the cuts. That third cut, I voted for the first 2 of the cuts. The thing about the third one was the government was shut down and we weren't even getting any information. So I still think that it would have been wiser to wait.
How far from neutral are you at this point? You said you're not sure how much the Fed funds rate is restricting the economy. And is it safe to say that you voted in favor for holding rates steady in January?
Well, I wasn't a voter in January. The issue that we're facing, if you look at the restrictiveness, is what matters is the real rate, the rate minus inflation. So if inflation remains elevated at 3% or even above that, if you looked at core inflation, the new month that just came in is an annualized rate of 3.6% for core inflation. If inflation is 3% or above, then the level of real rate restrictiveness is not high, is somewhere close to what people think is the long run real interest rate that is neutral, the so-called R star. So I think let's just be a little circumspect making pronouncements about where rates are going to settle until we're clear that the inflation rate is settling back at 2%. If we're at an inflation rate of 2%, then, as I say, I think rates can go down more, even several cuts more from where they are today. But that's conditional on getting inflation back on path to 2%, which right now we are not on a path back to 2%. We're kind of stuck at 3%, and that's not acceptable.
Coming up, we explain why AI jitters shook the transport sector ahead on market domination. The Federal Reserve isn't expected to cut rates at the next meeting despite the better-than-expected payrolls and inflation data we got this week. We just heard from Chicago Fed President Austan Goolsbee. He says he wants rates lower, but he's waiting for more progress on inflation. Join me now to talk about all this. We've got Andrew Krei, Crescent Grove Advisors Co-Chief Investment Officer, and Joe Brusuelas, that would be the RSM Chief Economist. Guys, welcome to you both. Joe, I will start with you as the economist on the panel. Austan Goolsbee, talking to Yahoo Finance, says, you know what? I want to see some more improvement in inflation. Is he going to see that progress, Joe?
All right, well, first of all, if you wonder what central bank independence sounds like, it sounds just like Austan Goolsbee. And you're right on the money with the question, because he wasn't really talking to Jennifer about the CPI. He's talking about the PCE, which we'll get a week from today.
Fed's preferred inflation gauge.
That's right, and it's moving in the opposite direction of CPI. So we're going to see probably a 3.1% on the top line and core with some upside risk. Notice how he mentioned core inflation. Now, for everybody out there who's an equity investor, maybe you don't really dabble in bonds or FX. Core is the best long-run predictor of inflation. So when you hear somebody like Austan mention that, you want to take special notice of it. Because again, we're going to see a move to the upside. And I think my takeaway, or I know my takeaway here is Austan thinks we're at 3% going forward here.
What do you think?
Yeah, no, I would agree. Yeah, no, I do now. I don't think that's the end of the world. As a matter of fact, this goes on long enough. We're almost 5 years now where we haven't hit the 2% inflation target. 3% then becomes the de facto inside the market. And then we'll have to go through a regime change at one point if that sticks. You know, when I took a look at today's data, I was encouraged like everybody else was by the top line, and in particular, the policy-sensitive owner's equivalent rent series. That did slow to 0.2% on the month, and that's a very important improvement. But Austan, he wouldn't let it go. It's all about the services inside the CPI. It's 64% of the weighting inside the index. It was up 0.4% on the month. It actually increased. And we're still well above 3% there. So my takeaway is Americans live and breathe services. They're paying roughly, I think, about 3.2% on a year-ago basis. That's just where inflation is, and that's just where I think the economy is at this time.
So I want to get to Andrew, but quickly, Joe, given all this, your outlook for the Fed in 2026 is what then?
One rate cut after we get a new Fed chairman, if we can get one through the Senate Banking Committee. But right now, there's just no impetus outside Stephen Mirren, I think, and perhaps Christopher Waller, to cut rates anytime soon. I know when I have run my models, they do not suggest cutting rates. So that's just, I don't think, in the cards here.
Andrew, I want to bring you in here as well. And you're looking through all this, I know, Andrew, through a different prism, a different lens as an investor. Walk me through, Andrew, how you saw the CPI print, what you think it means for the Fed and markets.
Yeah, I think it was a bit of a Rorschach test in some respects, right? What were your priors coming into this? And then you could kind of interpret it in different ways. But I think we would key in on what we just discussed there in terms of core services and thinking about this stubborn level of inflation, the stickiness to inflation that ultimately won't allow the Fed to cut as much as being anticipated. But in the meantime, we think, you look at this earnings cycle here, you look at the surprise data, has been really, really robust and strong. The S&P 500, you look at the broadening of the rally in the market. We just think overall we're still in a really nice pro-growth type of environment here. It's hard to make an argument that the Fed is in a restrictive state at this point in time when you look at what's happening from a nominal growth perspective, from a corporate earnings perspective. And ultimately, as we're allocating across equity markets, that's what we're focused on, is corporate earnings, the strength of corporate earnings, the tailwinds that we feel like we're continuing to see, and then this broadening, this rotational trade out of tech into more cyclical industries, other areas of the market, value, non-US stocks. That to us is the theme that you want to keep playing over the next number of months and quarters.
Andrew, another big theme this week for sure, switching gears, was these AI disruption fears, Andrew, right? You saw it just hit different industries, different verticals. It was software and then wealth management and then trucking, Andrew. How are you trying to navigate that as an investor? You go to sleep at night, everything seems okay. You wake up and Sam Altman has thrown a grenade at some stock you're in. How are you trying to just make your way through what appears to a lot of folks at this point like kind of a minefield?
Yeah, there's, I think, a lot of paranoia at this point, certainly, and probably a bit overdone in terms of some of the reactions that you've seen to these companies that are so entrenched in so many ways. And this idea that you can just completely upset, enterprises in different ways because of AI overnight. Sure. Will AI have an effect with a long tail? Of course. It's going to infiltrate the economy in different ways. But from our perspective, look, we're allocators. We're allocating client portfolios in diversified fashion. If you look at the S&P 500 equal weight, is a great example, right? You've had this churn beneath the surface, but you haven't had as much of an actual impact at the top line level. And that speaks to this idea of intelligent capital allocation. And from our perspective, taking a diversified view across markets is an important part of that. And even, geographically, as I talked about before, too, you haven't seen as much impact within non-US markets at this point. Maybe eventually some of that paranoia creeps in there too, but from our perspective, it's really about intelligent, thoughtful portfolio construction, and that's how you mitigate these types of risks.
So Andrew there, Joe, he's talking you through how he sees AI as an investor. How are you thinking through it, the impact as an economist on the economy, on GDP, on the labor market?
It's a transformational and disruptive technology that's going to touch every area of economic life in the United States going forward. Now, my sense is we're still dealing with what I call the machine learning, large language model, advanced neural network era. We're not really in the AI era yet. There are some amazing things that some of these agentic bots can do. I use one every single day. Actually, I use multiple now every single day. But we're not to the point where I can take a step back and say, you know what? Total factor productivity is rising well above 5% because of AI. That's just not where we are. So I'm not expecting the Federal Reserve to take excessive risks around that. However, when we went through that labor shortage in 2021, 2022, and 2023, firms did the rational thing. They couldn't find workers, so they invested in productivity enhancing capital expenditures. We're now reaping the benefits of that. We got a nice run here on productivity. So I'm very, very confident the economy is going to do very well this year. And look, he got it right. I think there's 130 billion that's going to be showing up in the pocketbooks of Americans in the first half of this year due to expansionary fiscal policy, the tax cuts. We know a little bit about audit, tax, and consulting at our firm. Believe me, we're going to have quite the tailwind that's going to juice earnings in the second and third quarter.
That sounds pretty good. Andrew, and here with you, I know in terms of sectors, Andrew, I know you think tech faces kind of a relatively high bar. What are the sectors, Andrew, you say, the risk reward looks attractive here?
We still look at the value side of the equation, and just really we think about kind of tech versus everything else. But if you had to pick a couple, you look at financials, you look at industrials, sort of quintessential value sectors in this environment. Really nice, quarter from an earnings perspective, at least what we've seen reported thus far. We just think there are tailwinds there. Not only as you get a little bit of these productivity and efficiency improvements as they continue to adopt technology, AI, we think that's an area where you get the second and third order effects. But those to us look like they're just still fundamentally mispriced relative to where they ought to be, particularly against the tech sector. Again, if you think about this relative value rotational opportunity, that to us is where you want to be looking.
All right, Andrew, Joe, thank you guys both for your time today. Appreciate it. Great chat. AI disruption fears look to be spreading out beyond software. Yahoo Finance's Jared Blickery joining us now with a closer look in the latest stocks in translation.
This week, the markets have been unnerving investors. A microcap that used to be a karaoke company lights up a press release about AI logistics. Suddenly, transportation stocks are getting pummeled into the ground, all in the name of AI disruption. What started in software led to drive-bys on real estate, stock brokers, asset managers, insurance brokers, and yes, some transports too. It's called the AI scare trade, and that's what we're digging into on today's Stocks in Translation. And if there's a common theme, it's AI killing the middleman and building a better, in quotes, more efficient pipeline. So let's take a look at the evidence, starting with software, ground zero of the sell-off. This heat map here is a look at year-to-date returns, and most of these stocks peaked late last year, but the selling really intensified at the end of January with a capitulation in the first week of February. We just talked with Tom Bruni, editor-in-chief of StockTwits, who laid it out plainly.
They're having to figure out how to implement AI into their businesses to avoid becoming completely obsolete, and the market is still trying to figure out what the right valuation for those companies are.
That word, valuation, is the whole game. AI kills the old multiple, or AI builds a new moat. Now, fast forward to this week, the fear does not stay in software, it leaks. It looks for the next easy target, and that takes us back to transports. And I'll put this on a 5-day view. When a tiny little microcap name decides to drop an AI logistics headline, short sellers jumped on the biggest names in the business and forced all the longs out who didn't have diamond hands. Big names you might not have heard of were down double digits, like Expediter, Landstar, and RXO. But only a few days before that, brokers and asset managers were the target, and we have a look at that here. Because this bucket is literally the business of advice, planning, and finding the right thing for the right person and getting paid a fee for it. An AI-driven tax tool was released into the wild, and the thinking was, who needs intermediaries at any level? AI kills a fee or builds a super advisor. LPL Financial, Schwab, Raymond James, even wealth giant Morgan Stanley got hammered. And then fear hopped to a different industry yet again, this time to real estate. And this is where you can feel the market getting a little bit lazy. If AI does more white-collar work, do we really need as much office space? Or so the thinking went. And if AI can build out comps, write listings, generate decks, summarize leases, what happens to the human middle layer of the transaction? AI kills a deck or AI builds the deal flow. But it wasn't all about selling. We did see rotation into some defensive areas, giving the market some green relief and keeping the indexes from steep declines. Check out consumer staples here. The stuff we need from Walmart and Kroger, the stuff made by Clorox and Unilever, or utilities here. As guess what? AI still needs gigawatts of electricity. So once again, boring utilities becomes a hedge in a non-traditional way. Or even home builders here, because AI bots are not digging basements and putting up drywall just yet, and humans still need shelter. So this is a part that keeps the base case alive, but the shotgun short selling still has a hangover. Here's Tom Bruni again.
So we're just in this environment where people are very fearful of software stocks and the overall industry impact, and it's kind of like sell now, ask questions later.
That is the AI scare trade in one breath. So how does this end? It really resolves in one of three different lanes. First, short sellers headlines. Those headlines might spread to new industries. That's your sideways case. The index can look okay while the market plays whack-a-mole with whatever business model feels most automatable this week. Second, rotation shifts to sell everything days. This is your bear case. Correlations jump, the market stops discriminating, the safe havens stop feeling safe. But third, software and hyperscalers, they could lead again. This is your bull case. The market decides that the winners are the ones who sell the shovels, not the ones afraid of the dig. And finally, the real-world confirmation signal, stimulus and refunds start showing up in the spending data. If that cash flow support is real this year, it can keep this from turning into a prolonged wipeout, even if the next few months are bumpy and frustrating. So tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Back to you, Josh.
Thank you, Jared. Well, coming up, we bring you the top trending tickers on Yahoo Finance. Stay tuned. Now time for some of today's trending tickers with Yahoo Finance's Praz Sumeranian. It's going to start here with Rivian. The name Praz knows well. Those shares, they're jumping. Except the company's earnings beat, strong guidance. So better than expected Q4 results. First ever annual gross profit. There's a milestone. You spoke to the CEO. What do you have to say?
Yeah, I mean, they're very excited about, he's really excited about R2. That's the new upcoming, the mid-size EV SUV.
30% pop.
30%, it's got to be the biggest day in their history, right? I mean, R2, that car's coming in Q2. They said they're on track for customer deliveries. The validation builds are happening in the factory. Their guidance for the year, over 62,000 or so vehicles a year, was better than Wall Street expected. Like you mentioned, a profit for the year, gross profit, but driven by a lot of software and services sales to Volkswagen, who are their JV partner. So a lot of good stuff happening there with the company. Also, RJ Scarin said they might look at opportunistic with regards to capital raises, which caught me by surprise, meaning that is part of the equation if need be, but they have $6 billion of runway at the moment, so they should be okay. It's all about, can they execute this year? Can they sell a lot of these R2s that have a much better bill of sale materials, less for them costly? Yeah, make money, right?
Let me ask you, there's some analysts I know who cover this space and these names, and they say, dude, in the U.S. EV market, they'll say Tesla still stands apart. It's Musk's world. And they'll say Rivian, we'll give them the silver, but Musk rules it. Is that how you see it, or no, you think you would compare and contrast them differently?
I think that's probably accurate for now, but if R2, which is getting some grave reviews right now, it's basically the same size as the Model Y, right? Model Y is one of the top selling vehicles overall in the US, let alone an EV. It's the number one easily selling EV. If the R2 can compete at that level at price, functionality, looks, right? Looks very different, not so bubbly as the Model Y does. I think Rivian has a strong case to make that, hey, we can make popular, effective, efficient, and also profitable EVs like Tesla.
Team at Canaccord Genuity, they got to buy on this one. Here's what they told the clients. They said, we love a good product story. Rivian is ready to launch and ready to meet the moment of truth. Love the drama. Moving over to Applied Materials, those shares ripping higher after reporting Q1 results. Why do we care about Applied Materials? Because this is the biggest U.S. supplier of chip-making gear. That's why you care. This stock is a monster. It has surged, upbeat sales forecast. The CEO is basically saying, listen, I'm seeing these acceleration in industry investments in AI computing, and that's a big tailwind for me and my company. Stock is up now 90% in the past 12 months. And you know what? Even here at these levels, Praz, about 80%, more than 80% of analysts say, yes, Praz, you should buy this.
I mean, I think the stock is up 30% this year. I mean, not including today's move. I think it's
roared
insane.
into that print.
I mean, these chip makers still making the money machine go burr, right? I mean, this is just massive, massive gains here. Look, all tied to AI, right? Supporting those orders, chips, right? Chip making, fabrication stuff here, right? Management pointing to leading edge logic chips, high bandwidth memory, using these data centers, right? So the question is, how long can that trade last, right? Are we many people? It's really two sides of two big trades, right? It's bubble, AI bubble, not going to happen, or this is just the beginning of the massive, massive AI build. I mean, you're talking about gigawatt style, 1 gigawatt data center.
Yeah.
Cost.
Yeah.
$30 billion. You know,
huge amounts.
How many?
Huge amounts of money because all these tech CEOs say, you know what, we're chasing demand. We can see the utilization. I like this comment from Bernstein Stacy Rasgon, friend of the show, one of the best in the game. He looked at this applied materials print. He took his target to 425, said we like the semi-caps here, the heavy lifters he calls them, the AI area. He's preferred AMAT, he said. He lists the reasons. He says high exposure to key areas like DRAM, lower China exposure versus peers, cheaper valuation, tells his clients we see no reason to change our view on that at this point.
And maybe it's a better bet, not better bet, but maybe it's a safer bet than NVIDIA, which is so leveraged to the AI build out, data center build out. But also, I mean, talk about Corsair today. Corsair, big DRAM maker, right? Big for not just gaming, but also data centers and also just chip making in general. I mean, just having a huge day today. So this trade is really rolling on today. And I just had to wonder, you know, we talk about, I saw a stat today that software stocks are now flat for the last 5 years or something like that.
We'll pull up a chart of the IGV, man. It's just right back to April lows of last year. It's brutal.
Is the money just pouring into this, right? That's the big question.
All right, finally here, Apple coming off its worst trading day since April with Siri and FTC in focus. You know, different headlines this week, Praz. Not great for Apple. So yeah, the FTC chairman, he issues a letter to Tim Cook, says the company could be violating the FTC Act if it misrepresents Apple News or violates terms of service. Bloomberg's Mark Gurman was also reporting, we referenced there, Apple's latest attempts to launch the new and improved Siri. That apparently, according to Gurman, running into some snags. We're off today.
I mean, the FTC stuff is somewhat notable, but I think the big thing is Siri, right? This is supposed to be the new update, 26.4, I believe, coming out this spring. Gurman talking about how that's being pushed back. I mean, Siri, so many issues. Let's start with the fact that the product itself is not so compelling at this point still. Was it a year and a half ago we had that big WWDC talking about what's going to happen with Siri intelligence. All these features that we were all kind of clamoring for, possibly not real, possibly just vaporware. And now that we're kind of hearing that, it's something that very un-Apple-like to show something that's not fully ready, right? And then we heard, okay, Google Gemini coming on board as a partner. That's going to fix a lot of these things. Great, we're excited about that. Finally, some full integration between what's happening in my calendar, my emails, and tell Siri to help me out, rebook a flight, etc. That's what we kind of want. And we're thinking that we were going to get that, but now we're hearing, according to Gurman, not so fast, maybe later this year.
The only pushback I would say there is that I would look at that last earnings report from Cupertino, and I remember talking to Howley about it. I'm like, dude, that was a solid print. iPhone growth was up, I think, 23%, beat the street, which leads me to believe that for all the talk right now, you know why people still want new iPhones? Processors, cameras, batteries, same old, man, same old.
Well, yeah, it makes you think like, we didn't need it before, right? We're all using iPhones anyway. Do we need the Siri intelligence so badly?
I'll tell you what you need. You need that foldable, maybe coming in September. That's what's on.
Yeah, did you see that? Yeah.
Praz, thank you. Thank you, sir. All right, power demand on the rise amid the data center build out, but with an aging infrastructure, the risk of electricity shortfalls also rising. One company working to fix that is American Superconductor, and Yahoo Finance's Julie Hyman had the chance to speak with the company's chairman and CEO on what's to come.
Well, a lot of it we have simple electrification happening, right? Everything that you use now uses power, right? So you're becoming more and more dependent upon it. And the pain points really come from, do you have access to reliable power for manufacturing or for consumers? And as you're more dependent upon it, it has to become more reliable. There's a real challenge, I think, in the market where people that are used to computers assume an uptime of a certain level. And the electricity grid isn't designed really to do that. So there's going to be tremendous investment into the grid to really bring up the level of service, meaning being able to provide resilient power all the time. And that's just an investment that's going to have to happen because we're asking the grid to do more than it's designed to do.
So to just back up a second, when we talk about the increasing electrification, people focus on things like electric cars. And electric cars are part of it, but like heat pumps, right? Which are sourced from electricity. What are some other real changes you've seen?
You just think about everything you touch throughout your day. Pretty much half of the things you physically touch consume power,
by
right?
Electricity
and
first,
everything more and more is trying to get smarter and talk to more things, and they all require electricity. The overhead lights, although we've tried to bring demand down, it's a big demand for power. And most people don't really understand what drives their power bill. I've seen, in talking to utilities, they've had a lot of outreach to help lower consumer demand, and that's worked to some extent. we're now asking, manufacturers are asking for more reliable power, computational capability, data centers, things like that, really need high levels of power quality and persistent level of power. And that's a challenge. And it's a challenge, I think, that will be met, but it's going to take time and investment.
And there's a lot of different questions involved here. So leaving aside the question of power generation and where it comes from, how do you make the electricity? There's that question of reliability, which you brought up, which is also has implications for what we all pay for power, what companies pay for power. Because if you have to update the grid, it's going to cost a lot of money. And it doesn't seem like there's any way around that. It has to be done. Is it being done right now, though? Are those reliability investments being done?
I'd say that they are, but they're probably not being done at the rate that we think the future is going to need, right? So I think that there's a little bit of playing catch up that's going to happen. But in at least my discussions with utilities, they understand the problems ahead of them. They're very well suited and very well positioned to do that, but it's going to take time and investment to be able to get there.
And who's going to pay for it?
Ultimately, it's going to come down to the consumer. It could be the individual consumer, but it probably will mostly be burden of industry or businesses that are very electricity sensitive.
And I know to take it out a little bit to the power generation side of it too. I mean, that's also part of the problem is that there's only so many natural gas plants that can, et cetera, et cetera. So I assume we're also going to need an increase on the generation side.
Yeah, and we're seeing some benefits from that as well. One of the things that we've done as kind of an expansion of what we do even since we first met is to become more a participator in traditional energy. So how do you make and move those modalities of power? There's a tremendous investment going on there that's going to have to continue. I mean, our lives are becoming more electric. And the world has to be able to meet those demands.
All right, let's bring it to your business. All of this is good for your business, right?
It's all great for our business.
Because the utility business, that transform business is still the biggest part of your business.
I wouldn't say specifically transformers. It's part of what we offer. A lot of what we do is we power and we provide power quality, power conditioning. So for problems to mitigate, a lot for industrial consumers. So as they're going to build plant equipment, which is going to generate more capability capacity, they need more power and they need more reliable power. And that's where AMSC comes in and kind of fills that gap. How do we get the grid to do more locally for that local capacity investment?
And what does that demand look like and where's it coming from?
Yeah, it's coming from a variety of markets. So for us, I mentioned traditional energy, a lot of materials, so mining, processing materials, a lot of things in traditional energy like oil and gas. We do have businesses as well directly to utilities. We have a small part of our business that's still with military, but a lot of it's really going to be driven by the manufacture processing of materials and fundamentally energy. How do we move the oil and gas to where it needs to go?
And we've talked about it a little bit before, but in terms of sourcing, making your stuff, supply chain, tariffs, how is that all working at the moment?
It's worked out pretty well for us, I think, because we're in a little bit of a unique situation. For our American-made products, our supply chain is almost all in America. So we don't really have to worry so much. There'll be a part here or a part there, and people on the team get very focused on that to make sure we have reliability of supply. But from a cost standpoint, it really hasn't hurt us financially in the aggregate. We're also now starting to look at other markets in Latin America.
Right, you guys
South
just
America.
made a big acquisition in Brazil, right? Are they facing the same challenges that we're facing here in terms of the grid, in terms of data centers, et cetera?
They're facing all those challenges and they're investing maybe differently. So there's a very large central government investment in the grid. And we see that as a great opportunity. That's a company that we think can grow pretty substantially in the coming years. And eventually we see the ability to bring everything we have to bear across the entire Americas.
That reminds me of something else I wanted to ask you, which is whether you think that policy here is supportive enough of grid resiliency. Do you think there is enough sort of policy attention being paid to this issue?
I think it's becoming more front and center. We've worked with some utilities and some state governments to look at resiliency as another economic factor. So not just being able to provide at a certain cost, but to have that stability and resiliency and looking at scoring of a project. It's a difficult market for utilities to defend my customers. They have a regulated environment. They're not trying to raise rates on people, but as the demand happens and the grid is asked to do more, like you said, that investment has to come somewhere. And I think utilities are able to meet that demand, but it is going to take time and investment.
Coming up, an expert gives us the do's and don'ts for using AI to do your taxes. That's next on Market Domination. Tax season is in session with millions of Americans once again racing to organize documents and file on time. This time, a growing number of filers are turning to AI-powered tools to speed up preparation, raising new questions about accuracy and limitations. Here to discuss all this, we've got Dan Geltrude, founder and CEO of Geltrude and Company. Dan, it is great to see you. So let's dig into this, Dan. So AI can now help you prepare a tax return. There are risks to that, Dan, and we'll dig into those. But I am curious. I mean, listen, you obviously know this business backwards and forwards. I'm curious to get your take on what you think maybe AI could be useful in with this. Because I read reports, Dan, where folks say it could be helpful with certain tasks. Folks say extracting data or maybe identifying overlooked deductions. But what do you think?
Well, let's keep in mind to start with that AI is not going to replace people completely. Now, there are certain functions that AI is certainly capable of assisting with, primarily when it comes to organizing data. That's what AI is really good at. So it certainly is a tool. It absolutely can assist in preparing tax returns, but it is not going to completely replace the human factor, at least not yet.
What could it get? I guess the question would be, Dan, let's say you're using AI, right, to help you out with a tax return. What would be the worry? That it would get the math wrong, that it would misinterpret an issue? Like, what would be the concern to you?
Well, you bring up a good point there, because AI does not understand the taxpayer's intent, right? There is a human factor that goes into preparing a tax return. Let's put it this way. AI is extremely rigid in what it is programmed to do. So there is, shall we say, a limitation in judgment. And that's where the human factor comes in. And that's where people need to be careful. AI, again, is a great tool, but it is not fully developed to this point, and it does have shortcomings. And that's what people need to recognize.
Barron's dug into this, Dan. They had some great stats. I'll just read you one of them. In terms of the impact here, they say AI reduced prep time by 12% for people and up to 30% for some firms. Now, that sounds pretty impressive. I guess your point is that, having said that, in your opinion, people still need to be involved in the process, at least now.
Absolutely. Look, if you take it from my standpoint related to it being an accounting firm who is preparing tax returns. So what happens is at the lowest levels of the preparation process, and what is that? That is the input of data into the actual return. Yes, we are using AI in that regard, and it is a time saver. Now, what happens is that frees up time for tax preparers to be able to apply judgment into that return. Now, what do I mean by that? That is looking at audit risk, looking at the nature of deductions, things that seem out of place, too high, too low. And that is, again, the human factor that you need to consider when preparing a tax return. Yes, there's time saved in one area, but it allows for the human factor to be applied to other areas of tax preparation.
Are there certain folks, Dan, certain categories of workers where you would say, listen, if I were you, I would not be using AI tools at all, that your tax situation is just going to be too complicated?
Other than an extremely basic tax return, I believe that really everyone should be using a tax preparer. Now, that may seem self-serving, and I get it, but in defense of that comment, I would say when you have a good tax preparer, those are the people that can apply strategy and advice to your tax return. I just don't think that you're going to get that same level of insight from a an AI function. So that's what I would say in terms of a good tax preparer should be saving you legally enough money to justify why you're using them.
Can I ask you, Dan, I'm sure there's some folks listening right now who say, well, what about TurboTax or H&R Block? I mean, their technology, their software, their tools. I don't know to what extent you have line of sight there, but would you say there are risks there, or that's just fundamentally different than the AI chatbots we're talking about?
Well, when you're comparing AI versus TurboTax versus an H&R Block, those are three completely different things. When you're using AI, it really depends on what the application of that AI is. When you're using TurboTax, you're actually preparing the tax return yourself. When you're going to an H&R Block, you actually have a human factor involved in their process. Now, I don't know to what extent H&R Block is using AI. I'm assuming they're at least starting to use some applications of AI. So really, the best of all worlds here is that you have a competent tax preparer that is using AI as a tool, as an assistant to be able to prepare a complete and accurate tax return.
Final question, Dan. If you spin out 5 years from now, and this technology is moving so fast, Dan, so quick, I mean, what kind of impact do you think AI is going to have on your industry?
Well, it's going to have a significant impact on the industry, just like it's going to impact all industries across everything, because AI is so powerful and we're really just starting to scratch the surface. So where are we going to be in 5 years? I couldn't even begin to guess. But again, I still go back to, as AI replaces certain functions, it is going to open the door for other types of services that people will need. I mean, a robot is not the same as a human. And at some point, if they can in fact replace humans, I don't know. I guess we'll all be sitting at home relaxing during tax season.
Dan, so good to have you on the show today. Thanks for your time. I appreciate it.
Thank you.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.